Right, so again, let's revisit what we covered on Tuesday. So we're learning about financial management, how to manage a company's finances, and the securities markets where securities are sold. And who can remind me what securities are?
Like a financial instrument,
Financial instruments,
a tradable like a stock.
like a stock, exactly, or a bond. Those are both considered types of securities. So I did take you through this chart showing how safe investments like government bonds, you have very low risk when you buy them, almost zero risk that you're not going to get your money back, but you get very little return. Maybe just a couple percent, or maybe longer term bonds might give you 5-6%, something like that. Whereas with a more risky investment like stocks, there's a chance you lose all your money that you invested, but you could make a lot more money. Some stocks have returned 5, 10, even 20% per year, which is great. That grows your money pretty quickly. There were several questions I saw as I graded the video discussion questions about whether you can go into debt when you invest. So as a general rule, if you spend some money on an investment, you could lose that money. But that doesn't put you into debt. That just means you lost your investment. There are some ways you could borrow money to invest, and then, yeah, the investment doesn't work out and you borrowed money to do it, yeah, then you end up in debt. Okay, so just keep that in mind. In general, people don't do that because that's even more risky to borrow money so that you can invest. So if you just put money in, you could lose that money, right? That's the most likely worst case scenario. And we talked about where companies get money from and where they spend money. We talked about the role of the financial manager. They need to think ahead and plan for how much money does the company need to accomplish whatever it wants to do. So again, it relates to the strategy of the company. So if your strategy is to expand your organization, to buy another company, to what else? Well, those are the main things companies try to do. To roll out some new products, all of those things cost money, right? So where do you get that money from? That's what the financial manager has to estimate how much money they need and figure out where that money is coming from. Do we borrow the money? Do we issue bonds? Do we sell stocks? Those are the main options. That's financing. But then if the company has extra money, how do you invest that money? We saw the video of Silicon Valley Bank, right? They had some extra money. They bought some very safe long-term bonds, but that turned out to be a bad mistake. Why was it a mistake for them to use those long-term bonds to invest their money? Why did that end up being a problem for Silicon Valley Bank? No? Well, that's true. It was a combination of things, but that was part of it. So yes, the major mistake that they made was to put too much of their money into those long-term investments. Those bonds that they bought were very safe. So it wasn't a risky investment. What was risky is they put so much of their money into that one basket, so many eggs into that one basket. Because a couple things happened. Not investors, but depositors, people who had put their money into that bank, some of them started to want to take it all out. And that's normal, but when a lot of people start to take out a lot of money at one time, then the bank has to come up with the cash. And their money was tied up in these long-term investments. And because interest rates had gone up, the price of those bonds had gone down. I think I mentioned that on Tuesday. With bond interest rates, when they go up, the price of the bond goes down and vice versa. So it was bad timing. At the time that Peter Thiel and his buddies decided to pull their money out of the bank had too much money tied up in these long-term bonds. Interest rates had gone up, so the value of the bonds went down. They couldn't raise enough money by selling the bonds to satisfy all the depositors who wanted their money. Now, somebody had asked also the question about why do bond rates go down when interest rates go up? So that can be kind of confusing, right? When people are saying, oh, bonds are up, are you talking about the prices or are you talking about the interest rate? Because they're opposite of one another. So I'll try to just simply explain it. Imagine you buy a bond that pays you 5% interest. Okay. So you spent, let's say $1,000 and you're getting 5% interest every year. And now interest rates have gone up because the Federal Reserve decided to raise interest rates. And so now you could buy the same bond but get 6%. Well, if you're an investor out there, you're not going to buy the 5% bond, you're going to buy the 6% bond, right? So the price of that 5% bond has gone down because it's worth less. If people can go get a similar bond with the same amount of risk, same length of time, but a higher interest rate, the only reason they might buy the 5% bond is if you sold it at a discount. So when interest rates go up, bond prices go down. And then the opposite is true. If interest rates go down, bond prices go up. The bonds get kind of tricky. There are some investors that really focus on bonds and make a lot of money by trading bonds, but it's just like trading stocks. You know, it's risky. Even though there's safer investments in general, if you time it wrong, like Silicon Valley Bank did, you could lose money. Because nobody really knows what interest rates are going to do. You never know. So, all right. We talked about the trade-off between risk and return. I kind of mentioned that earlier. The more risk you take, the more potential return or potential loss, right? So when you take a risk, you might make more money, but you might lose more money. All right, we looked at some of the things companies spend money on. We looked at what they can do if they're short on cash. They could try to collect faster from their customers. They can delay paying their suppliers, and they can stock less inventory, right? Those would be all ways to free up some cash. And let's see. Did we cover this slide? I think we did.
Yeah, we did.
Yeah.
Okay. And then, does this one look familiar? I think I briefly talked about this slide.
Yeah.
Yeah, okay. All right, so let's go ahead and just review these two slides and then continue on. All right. So the company decides to raise money by borrowing money. They could take out a short-term loan of some sort, or they could take out a longer-term loan. And typically you use short-term debt for short-term expenses. And you use long-term debt for long-term expenses. Sort of like if you're going to buy a house, which is a long-term investment, right? You're probably going to live in it for a number of years. You would use a long-term loan like a mortgage, unless you happen to have enough cash, right? But not too many people have enough cash to buy a house. So we use long-term debt for long-term investments. And for short-term needs, like just paying the bills this month, if you had to borrow money, you wouldn't go take out a 30-year mortgage. You would maybe hit up a friend, or maybe go to use a credit card, something like that. Not that I advocate credit cards, but it would be better than taking out a 30-year loan just to buy groceries, right? So same thing with companies. They've got short-term options. One is when you purchase from your suppliers, just don't pay them right away. They're usually fine with that. They'll usually give you, depending on the supplier, maybe 30 days, maybe 60 days to pay what you owe them. So that's great. That buys you some time and frees up some cash. Or you could go to a bank or commercial paper. Does anybody remember how I described commercial paper? How is that different from other loans? It can be as short as just a couple days. So that's perfect for a company that expects some money to be coming in a few days, but it's got some bills it has to pay today. So it might just take out some very, very short-term loans. Not going to have a whole lot of interest. It's not going to have a lot of cost because they're going to repay that loan within just a few days. That's called commercial paper. I also mentioned if your customers owe you money, that's called accounts receivable. And that is an asset. That is something of value. So even though you haven't received that money from your customers, the fact that you're expecting to get that money, you could use that to secure a loan. So when you go to the bank and they say, oh, we're not so sure we want to make a loan to you, do you have any asset you can pledge to us so that if you don't pay us back, we can take that asset? You could say, yeah, I've got these accounts receivable. And the bank might say, great, sign here. We'll lend you money, and then if you don't pay us back, we get those accounts receivable. You could also sell the accounts receivable to a collection agency, but you lose the majority of the value. So you get pennies on the dollar if you go that option. So that's only good if you're like completely desperate for cash and can't take out a loan. So here, I think I just quickly on Tuesday explained the pros and cons of debt versus equity. So debt basically is two things. It's either a loan where you're borrowing money from a lending institution, but debt could also be a bond. And I think I mentioned that on Tuesday, how if you're an investor and you buy a bond that I'm offering, you're really lending money to me, right? And I have to pay you back. So even though for you it's an investment, for me, it's debt. And how does that differ from equity? What do we mean by equity financing? Ownership. It's stocks. So in that case, if you're the investor and you buy a share of stock, you give me money and I give you part ownership in the company, right? Every share of stock is part ownership. So the more shares you have, the larger portion of the company that you own. So those are the two main ways companies can finance. Debt being loans or bonds, and equity being stocks. So with loans, they have to be repaid, right? Whether it's a bond or a loan from a bank, the corporation has to pay it back. If it doesn't, well, it's legally responsible to, so it can be sued. Even if it goes through bankruptcy, it might have to still pay back part of that debt. It has to be paid back by a specific date. Loans and bonds always have a date that they need to be repaid by. There's a cost, there's interest that has to be paid. However, you do get a little bit of a tax break. So companies are able to write off the interest as a tax deduction. So that means, let's say you're spending $1,000 a month on interest. Well, that reduces how much you're taxed on by $1,000. So let's say the company had a profit of $100,000 for the year, but it had $12,000 of interest that it paid on loans. So you would take that profit of $100,000, subtract the $12,000 of interest, and the difference is now how much the company's gonna get taxed on. So they'll get taxed on 88,000 instead of getting taxed on 100,000. So you get a little bit of a tax break. Debt financing. With equity financing, you're giving up some ownership of the company, right? So the more shares of stock you sell, the more you give up control. Because those investors can vote the way they want. They could throw out the board of directors if they have enough shares of stock. They could, require the board of directors to throw out the CEO. So think back to Apple. I might have told you this story before, but who were the founders of Apple?
Steve Jobs
Steve Jobs
and Steve Wozniak.
and Steve Wozniak. Those were the two original founders. And Steve Jobs became the CEO of the company, and it became very, very successful. But at one point, the board of directors said, we don't want you to be CEO anymore. So here was a company he founded, right? It was his baby, well, his and Steve Wozniak's baby, right? They started this company, they made it super successful. Steve Jobs is CEO until the board tells him, sorry, we don't want you to be CEO anymore.
Because he committed unsportsmanlike conduct.
Well, he was hard to work with, definitely. Yeah. You could say that. But he was also brilliant as an entrepreneur and a business person. So the point is, if you give up too much control, you don't know what's going to happen with your company. You can get thrown out. Same thing with Uber. One of the founders of Uber was this guy, Travis Kalanick. Got into trouble for his own personal behavior, and the board of directors kicked him out and said, you're no longer going to be CEO. So yeah, you can raise money by issuing stock, but you're giving up some control of your company. The nice thing about raising money by issuing stock is you don't have to pay it back. So you, the investor, buys the stock, you give money to the corporation. Corporation gives you shares of stock and never has to give you your money back. So I think we talked about this the other day, but how do you then make money from stock? There are two basic ways. Who remembers? How do you make money from stock?
Dividends.
Yes, dividends would be one way. Andrew, thank you. That would mean that the board of directors decided to pay out some of the profits to the investors in the form of dividends. What's the other way you can make money from stock? The more common, well, I mean, dividends are pretty common. Well, what is it when people buy stock, they're usually after?
Usually they buy low and sell high.
Exactly. They're looking for what are called capital gains. They want to buy the stock at a low price, sell it at a higher price.
Or short.
Or short selling. That gets a little more sophisticated. Yeah, and so there are some more exotic ways you can make money from stock too. So with equity financing for the corporation, you get money from the investors that you never have to pay back. It's then their problem, right? Whether they ever get dividends, whether they ever get capital gains, that's their risk. As a corporation, you got their money. You can now use it to grow the company. Again, the downside is you give up some control. All right. Questions or comments? Okay, so that was our review of what we'd already covered. So let's look at some new concepts. What if a company is going to use debt financing, but it's for some long-term investments, like they're building a new building, or they're rolling out some new product line, something that is going to take years? Well, they might want to use a long-term debt option. So one way is what's called a term loan. And actually, a mortgage is a type of a term loan. What term loan means is you borrow the money and you have to pay it back at a certain time. So the loan is for a certain term, certain period of time. And that's kind of seems like, isn't every loan a term loan? Actually, no. Because another type of loan is called a revolving line of credit. With a revolving line of credit, it's kind of like a credit card. you get approved to borrow a certain amount of money. You could borrow that money, pay it back, borrow it again, pay it back. So it just keeps revolving. There's no specific end date. The term loan is a one-time loan that you pay back one time. And a mortgage is like that. So if you are buying a building or land, you'll probably take out a long-term loan over decades. And that loan is secured by that building or that land. So if you don't pay it back, the bank gets to foreclose on your property. And then the other option is bonds, as I've already discussed. It says here, bonds are usually a year or longer. They can be 10 years, 20 years in some cases. There can also be shorter term bonds, especially like, US government treasury bills are less than a year. But most bonds are for more than a year. So these are some of the options for long-term debt. Any questions on that? All right, now this, this is about stock. There are two basic varieties of stock. The more common is called common stock, as you see here. And common stock gives the stockholder the right to vote. So for every share of common stock, that's one vote you get when the company is choosing the board of directors or anything else that they put before the investors, for a vote, you get to vote on. One vote for every share. You might get dividends. Some companies never pay dividends because they're so focused on growing that they just put all their profits back into growing the company. But some companies that are more stable, not trying to grow as quickly, they do pay dividends because that attracts more investors. Some investors really want those dividends. So if the company does pay dividends, you're more likely, you might get them if you own common stock. However, if you own what's called preferred stock, you're more likely to get dividends. Because when the board of directors decides to pay dividends, first they pay out dividends to the preferred stockholders. Then whatever's left over goes to the common stockholders. So what you're after is dividends as an investor, you're better off buying preferred stock. If what you're after is capital gains, you don't care as much about the dividends, you just want to buy low and sell high, as Aaron said, common stock might be a better bet for you. And so most people, when they buy stock, it's common stock. As I've told you before, the corporation has to get approval from a state to incorporate. And then they also have to get approval from the state to sell stock or to sell bonds. And if they want to sell their stock over a stock exchange, so the public can buy their stock, they have to do what's called an initial public offering, an IPO. Now, it might be interesting, because of this point in time we are today, to take a look at a recent, not quite an IPO, but it's a publicly traded stock that just recently started to take off. So if you follow the news, you might have heard about this. There's a social media company out there, a website called Truth Social. Donald Trump's a major owner of this social media site. Well, I was going to ask if anybody here is on Truth Social, but you might not want to admit it if you are. I don't know. So I'm not going to ask the question.
Apple's here in California.
Apple's, yeah, we'll get to that.
Apple's, I think,
You're a step ahead of me, Eric. We'll get to that. So Truth Social is a social media company. Let me ask you this. How many people have heard of Truth Social before right now? Not too many, right? Everybody's heard of TikTok, Twitter, Facebook, Meta, whatever, Snapchat, right? Truth Social is not that big, but it's partially owned by Donald Trump. And what recently happened was there's this other company that he partially owns that was publicly traded already. It was already listed on the stock exchange, so it could, I think it's on the NASDAQ stock exchange. And it had already gone through an initial public offering at some point so that it could sell stock to the public. But that company really didn't have a product or a service. So here is the social media site, that is a service. And then here is the publicly traded company, they merged. So now Trump has his own social media website that is publicly traded, that investors can buy in, can buy stock in. And initially the stock price went pretty crazy. So let's take a look and see how it's doing. Just out of curiosity.
NASDAQ up 1%.
Is it up?
Yeah, check Wall Street.
Let's look it up like this. Yesterday in my other class, I tried to look it up by the ticker symbol and it didn't work.
Yahoo Finance.
What's that?
Yahoo Finance.
Yeah, there it is. The DJT is the ticker symbol, also Trump's initials. And let's see how this stock has done.
Stocks are rebounding. They were down yesterday.
So this shows us how this stock has done over the past day. So it's gone from about $49 a share down to 46. Okay. That's not good, but that's not that bad. If we look back over a longer period of time, you can see back before those companies had merged, who's going to invest in a company that doesn't have a product or service, right? So the price of that stock was pretty flat. Nobody wanted to buy it. And then the merger comes along and we see the stock price go up and down, shot up. This was the peak here, about $71 a share. And that was last week. And now it's dropped down to $47 a share. So the reason I bring this up, as an investor, remember Aaron said, and he was right, buy low, sell high. That's how you make money. You buy something at one price and you sell it when it's a higher price, right? Or you can collect dividends, but still, you don't want to buy something at a high price because then if you have to sell it and the price is lower, you lose money. So with that in mind, where we're at today, is that a low price or is that a high price? If we bought it today, are we buying low because it's lower than this point? Or are we buying high because it's higher than that point? Or does the past not really matter?
No, it's matter because all this is
Say that a little louder, Bree.
almost all they see that follow the pattern of a peak and over the down.
So there is a pattern, yeah. We see a
Always.
pattern, it's kind of up and down and then way up. And do we know what that stock is going to do in the future? Does anybody know? If they know, that's insider trading. If they know for sure what's going to happen with that stock because they have information nobody else has, it's illegal for them to trade on that knowledge. And the only way you would know that is if you had, if you basically were an executive in the company or something like that. So for an investor, you don't know. You can make an educated guess. You could look at the fact that this social media site is losing users and losing money and say, well, that's probably not a good company to invest in. But maybe somebody else looks at it and says, well, I think Donald Trump is going to be president and everybody's going to get on his social media platform. Personally, I don't believe that. I don't think that's true. But nobody knows. We really don't know what the future holds, right? So as an investor, yes, you can do your research. You can read what the analysts say. We can use computer models to try to project what a stock's gonna do. You could factor in supply and demand because that has a major impact on stock price. If there's less of a stock available, the price goes up. And if there's more demand for that stock, the price goes up. So just like products are influenced by supply and demand, so are stocks. But there's something else that impacts the price of a product or the price of stock. And that's human perception. When investors get scared, investment prices go down. Let's take a look at the S&P 500. Who can tell me what that is? What happened? What is the S&P 500?
It's a major stock market.
The largest fund.
Yep. Yeah, apparently Google doesn't know what the S&P 500 is. For some reason. What's going on? Internal server error, processing your request, okay. Interesting.
Oh, I have it.
Let's see. I've never had that happen before.
I have it in my computer.
What's that?
I have it in my computer. It's open.
It's open for you? Okay.
Yeah.
Let me try a different browser and see what happens. Okay, Microsoft, just let me. If this works. So S&P stands for Standard and Poor's. It's the name of a company that they've been around for a long time. And we'll talk about them more later, but one thing that they do is they created this selection of 500 corporations. They said, okay, this list of 500 corporations we think represents the overall US stock market. So they follow the prices of those 500 corporation stocks. And as the stock market goes up, you'll see that their S&P 500 index also goes up. So in other words, one of the best ways to see how the overall stock market is doing is to look at the S&P 500 index. And if we look at it over the past 40 years, we'll see that these 500 corporations, their stock price, gradually went up through the 80s and 90s, but it was pretty steady. All of a sudden, something happened and the stock market went crazy. We had this bubble that peaked right around the year 2000. Anybody know what that bubble was called? Commonly called the dot-com bubble, because that's when the first internet companies started to come out. Everybody, the investors were all saying, oh, this is the biggest thing, the internet. Let's put our money into internet companies, which made sense, except the investors were so exuberant and optimistic that they were putting money into companies that weren't even making a profit. And then when it started to be clear that some of these early internet companies really were not solid companies, the investors started to get scared and pull their money out. So you see, the stock market went up like crazy for a couple of years, and then it dropped just as fast. And a lot of investors, if they didn't get out in time, if they didn't sell high, they just waited it out and they saw their stock price go down low, and then they sold down here, they lost money. Back, to be honest with you, I was working for a dot-com company at this time, an internet company, and I bought their stock when it was at the peak, and I sold, well, actually, I never sold it. I held on to it, hoping it would someday come back, and it eventually became worthless. So, lesson learned. But that was a major bubble in the stock market. Then we had another bubble. This bubble was connected to the housing bubble in real estate, because housing prices had gone crazy up until around 2000, 2006, they kind of plateaued, and then they started to tank. Well, Wall Street had come up with ways to invest in real estate through the stock market. And so the stock market also went way up and then came down with the housing market. And we can see how quickly it came down in 2008. I was telling you on Tuesday about Lehman Brothers crashing in 2008 and how it was a major economic issue, and how many other banks were on the verge of going out of business at that time. So it was pretty bad there, but then within a few years, the stock market recovered and the overall economy gradually recovered as well. And then look at what's happened since then. If you think about, okay, this was the peak for the dot-com bubble, this was the peak for the next bubble. We've reached there about this point in time, I don't know, 2013 or something. But what's happened? It's just kept climbing and climbing. And a lot of that is well, it's for a variety of things. But one thing, during the Trump administration, corporate tax rates were lower significantly. So now corporations don't have to pay as much in taxes. And they could take that extra money that they're saving and buy back their own stock. Now, remember I said, if there's less supply of stock, that pushes up the price. So when they buy back their own stock from investors who are willing to sell it, stock price goes up. The corporation looks like it's very valuable. The stock market goes up too. Now we did have a big dip. Let's see. This was COVID, right? When COVID hit, the stock market did take a dip there for a couple months, but it pretty quickly rebounded. And then there were some other issues with China tariffs and oil prices and things like that.
Ukraine.
In Ukraine, exactly. But you can see where we're at now. We are at record territory in terms of stock prices. So is this the right time to buy stock? If we're at an all-time high?
Can, because it's proven that when you buy at all-time highs, you have a higher percentage income than buying any other day on the stock market. It's like
Really?
2 or 3% higher. Yeah, I think JP Morgan, they start showing the data.
So,
But you just don't want to, you should not get scared when it comes down. That's when people lose money.
okay,
It's all psychological.
right. So when you buy a stock, you only know what it's done in the past. You don't know for sure what it's going to do in the future, right? If you're willing to hold it until it gets to a higher price, then yeah. But in the meantime, it might be way low for a long period of time. So you have to sit through that time that you've lost money on paper until that stock eventually comes back up. Or like I did with the company I used to work for, I bought their stock here and it dropped from $9 down to like less than $1 a share. I kept thinking it's eventually going to come back. I'm going to hold on to it, but it never did, right? So you do take that risk as well. Okay, so the point is investor perceptions impact stock prices in the stock market. The famous investor Warren Buffett has a couple great sayings. He's got a lot of great sayings, but two that come to mind. One, he says, when everybody's scared, get greedy. When everybody's being greedy, get scared. And I think that's smart, because if you're just doing what all the other investors are doing, you might be falling into that trap of buying when things are reaching a peak. And that might actually be the right time to sell. But he's got another one, something like, when the tide goes out, you can see who's not wearing a bathing suit. So if the tide goes out and the water goes down, people are exposed. And his point there is, when markets are up like they are now, you see all these rich people buying houses and Maseratis and things like that. But when the markets turn, you see which of those people didn't really have a strong financial foundation. And they lose their house and they lose their Maserati. So, okay. Any questions or comments?
Same thing's kind of like crypto too. Like,
Yeah, yeah,
especially, it's really more, it's like, when it's, everyone's like, when it starts pumping, everyone wants to buy, that's like the worst time to buy.
exactly.
Because that's when all the people been holding money, they're gonna sell. And same thing with altcoins. It's like people putting money in these little companies hoping for big gain, but most likely not, most of them are not.
Exactly. So you never know, right? If you just follow the crowd, you might get lucky, but you might get unlucky, right? Because the crowd doesn't necessarily always make the best decision. So as an investor, it's smarter to have a financial advisor that can help you make these decisions and is not going to be so emotionally attached to your money like you are, and they can make more rational decisions. But they also have certain models. They know about diversifying your portfolio, right? They know about how much risk is too much risk and time horizons. Thinking about, when am I going to need this money? If I need this money next year, I better not take any big risks. If I don't need it for 20 years, I could take some more risk because there's time for it to go down and come back up. So, okay. So I talked about public offerings where you could sell your stock to the public. I talked about preferred stock. A couple more points on this slide. Retained earnings means the profits or earnings of the company that it retained. So if they made a profit last year and they didn't spend all that money, then they've retained some of those earnings. That's a big part of corporate finance because that's like your rainy day fund. Appropriate for today, right? It's that money that you have available. Maybe you don't need it, but you've held on to it just in case. Or maybe you do have some plans for it, that next year you're going to need some of that money, so you just held on to it and made sure you didn't spend it. Another important concept here, venture capital. And we are just an hour away from the birthplace of venture capital and the heart of venture capital, which is Silicon Valley. Who can tell me what venture capital is? Aaron.
It's basically they would invest in your startup, right?
Mhm.
In exchange for equity.
Yep, exactly. It's a group of investors that put their money together. They look for startup companies that usually in tech that they think can go from a small company to a huge company. And this group of investors will take their money, say, okay, we like your company, we're going to put a bunch of money in. Kind of like on Shark Tank, but it's a larger group of investors. We're going to put our money in. We're also going to kind of guide you through the process because we don't want you blowing our money. we want to say in what happens here. And that's how a lot of these tech companies go huge. Zoom was an example of that. When I started here at Hartnell, I had never heard of Zoom. I knew Skype. I knew other video messaging systems. And I was like, okay, well, here at Hartnell, we use Zoom. What's Zoom? Well, it was a fairly small company, but it was backed by venture capital. And it got very lucky. I mean, I'm sure it would have grown over time, but it got very lucky that the pandemic came along. And that when people decided they needed to find some way to interact, they chose Zoom as the most popular option, right? There was Google Hangouts. Nobody really used that too much. Skype was kind of going down for whatever reason, and Zoom became the popular one. So they were backed by venture capital. They had all the money they needed to ramp up, expand, and dominate that industry. So venture capital doesn't always get it right, but when they find the right startup and they put a bunch of money into it, it can become huge. If you have a startup company, especially in tech, and you want to go from being a small company to being a huge company, you're probably going to need some venture capital to do that. All right, the last thing we'll cover here before we do our grow activity This graphic here is the largest companies by market capitalization. In other words, if you take all the stock that the company has issued and you look at the value of all of that stock, these are the companies with the highest value in each state. So you can see, as Eric pointed out, in California, it's Apple. You take the number of shares of stock that they've issued times the price of that stock, it's worth more in the stock market than any other California-based company. You can see up in Oregon, that would be Nike. They're based in Oregon. Microsoft in Washington, and so on. Some of these you might not be familiar with, but ExxonMobil in Texas, that kind of makes sense, right? Because there's a lot of oil in Texas. FedEx is based in Tennessee. McDonald's is, what is that, Illinois? I think.
Yeah.
Yeah.
FedEx based in Tennessee,
Mm-hmm.
Coca-Cola in Georgia, Bank of America in North Carolina.
Yeah. Yeah, you're good at recognizing the states there. So that's just kind of interesting to see, right? What are some of the most valuable corporations based on where they are in the country? All right, does anyone have questions or comments? All right, well, let's take 10 minutes then, so get into your groups of 4. Or more.
In addition to RSP, we have to stop by the Cat Hut at the pub office to sign permission slips.
The Fresno trip?
Yeah.
Okay. All right, so we've talked about bonds.
Yeah.
I mentioned S&P 500, right? That's the index of the 500 companies that this company picked to represent the stock market. And the company, S&P, their full name is Standard & Poor's. And that's not the only thing that they're known for. In addition to the index that they created, they're also known for rating bonds. So if you want to buy a bond, you want to know how risky is this bond. You would look at the rating that it has. If it's a AAA bond, that means that that organization, whether it's a corporation or a government entity, is so financially secure, there's almost zero chance that you're not going to get your money back. So those are the safest bonds, AAA rated. In fact, the US federal government is rated AAA. There have been times when they got downgraded to AA, times when Congress can't agree on a budget and they shut down the entire federal government. That usually, or at least, I think it's happened twice, where that has caused the rating agencies, or at least one of them, to say US federal government bonds are now not quite as safe. But over time, government got back to work and the rating went back up. So the safest bonds are AAA. As you see, there's AA, single A, you get down to triple B. Double B bonds are considered junk bonds. They're more risky. There's a greater chance that when you buy the bond, you might never get your money back because the organization might go out of business. Even if it's a government agency, you might think, how can a government go out of business, right? How could a county or a city or a country go out of business? Well, they pretty much can't unless they get conquered in a war, right? But they can file bankruptcy. Orange County, California filed for bankruptcy. Detroit, Michigan filed for bankruptcy. And when they do that, they get out of paying some of their debts, including some of their bonds. So even with government investments, government bonds, there is a chance you might not get all your money back. So that's why it's important to look at the rating. If you buy junk bonds, again, you're taking a bigger risk, but they have to offer you a higher percentage because otherwise nobody would buy their bonds. So you get more interest, you just take the risk that you don't get your investment back. Okay, so that's how bond ratings works. There is another rating agency called Moody's and a third one called Fitch. Now, in general, we can rely on these companies to fairly rate bonds. However, in the 2008 financial crisis that we had, in the aftermath of that, we realized that these rating agencies were doing some shady stuff. They were rating some bonds as being very safe, even when they weren't. Why were they doing that? They were getting some money for giving those good ratings. So unfortunately, there was corruption all around that 2008 financial scandal. Unfortunately. Okay. Oh, and one last thing. It used to be if you bought a bond, you got an actual bond certificate. These days, everything's digital, so you don't actually get a certificate. But that's what a bond certificate would look like, something like that. Okay, and some terminology here. If you buy stock directly from a corporation, that's considered the primary market for stocks. But we cannot do that unless you have like $1 million in the bank and many years of investment experience. You can't just go buy directly from a corporation. Or the majority of us, if we want to buy stock, we do it over a stock exchange. So we're buying it from some other investor that's selling it. And we don't even interact directly with that other investor. We do it through either an app or a broker or something like that. So that's called the secondary market. So when we talk about stock exchanges, that's the secondary market. You're not buying directly from companies, you're buying their stock from other investors. I've already talked about corporate versus government bonds. There are other varieties within those two categories. Bonds could be secured or unsecured. They could pay interest or not pay interest. So there are a lot of different variations, but we don't need to go into detail. Let's talk about these terms: mutual funds, exchange traded funds, and then things like futures and options. Who can tell me what a mutual fund is? Aaron.
Like a pool of securities.
Okay, it's a pool of securities. Perfect. Yeah. So some fund manager has said, okay, we're going to create this fund that buys maybe 70% stock and 30% bonds. And most of it's going to be domestic, some of it's going to be international. So they've created this pool of investments. And then you as an investor, instead of having to just go out and pick individual stocks and bonds, you could just buy a share of that mutual fund. It's already diversified. It already has a specific goal that it's trying to achieve, like maybe long-term growth or maybe income or whatever the goal is for that fund. The downside is that manager needs to get paid. So while buying a mutual fund is an easy way to get some built-in diversification into your portfolio, you're paying a fee for that. They're very common, actually. If you have a retirement plan at work, like a 401k, your investment options are probably mutual funds. So most Americans don't buy individual stocks. If they invest in the stock market, they usually buy mutual funds. Now, an alternative to mutual funds that's very popular today is an exchange-traded fund. And for short, they're just called ETFs. An ETF is like a mutual fund, but it doesn't have a fund manager. Instead, it just picks a particular index. Like I showed you the S&P 500 index earlier, right? And I explained that the company that created it, they just picked 500 corporations. Well, if you buy a share of an exchange-traded fund, that fund is investing in those 500 corporations if it follows the S&P 500 index. So it doesn't need a manager because it's just doing what the S&P already did. And by not having a manager, you don't have a management fee. So the fees on exchange-traded funds are super low. And you don't have to worry about picking individual stocks. If you buy If you invest in an exchange traded fund that follows the S&P 500, then you know as the S&P 500 goes up, your investment goes up. And as it goes down, unfortunately, your investment goes down with it. So you're basically just following the overall market with very low fees. Futures are betting on what the prices of things are going to be in the future. That's very, very risky. Options, similarly, are giving you the option to buy or sell a stock at a certain time, also very risky. So I would avoid that unless you've got money you want to just play with, you don't mind losing. That's getting into pretty risky territory. You could make a lot of money, you could lose a lot of money. If you're interested in understanding more about that, if you watch the movie The Big Short, it's about a group of investors that made a ton of money when the 2008 financial crisis hit. Everybody was losing money, but these were some of the only folks that kind of saw it coming, and they had a way to make money using shorts and other exotic sort of investments. So The Big Short, it's a great movie. And it's based on true things. Okay, questions or comments on any of these terms? All right, let's look at the markets where stocks and bonds are sold. There are two basic types. We've got broker markets and dealer markets. In a broker market, if you buy or sell a stock, you're working with a stockbroker, or at least an app that acts as a stockbroker that connects you with the other party. So you never actually interact with the other investor. It's all handled by the broker in the middle. With a dealer market, it's a little different because when you buy a stock or sell a stock, it's to the dealer or from the dealer. And the dealer actually owns the stock. So they'll buy on their own from other investors and then sell when they want to. So they actually take ownership of the investment. Now, some of these stock exchanges you might have heard of. As far as broker markets, the most famous one is the New York Stock Exchange. As far as dealer markets, the most famous one is the NASDAQ. That was the first computerized stock exchange. So it's been a favorite by tech companies like Truth Social, like pretty much any tech company you can think of that is publicly traded, their stock is probably on the NASDAQ. And if you're curious what NASDAQ stands for, it's down here. Now you can also buy stock that's not listed on a stock exchange. If it's not listed on a stock exchange, there's probably a reason. It's kind of like if you wanted to buy aspirin, you'd go to the drugstore, you wouldn't buy it out of the back of somebody's car, right? That'd be a little sketchy. So stocks that are not listed on a stock exchange, it's because the stock exchange doesn't want to touch it. And those are more risky. They're often called penny stocks because they're worth usually $5 a share or less. If you saw the movie The Wolf of Wall Street, and towards the beginning of the movie, Jordan Belfort, I think was his name, he was working for this pump and dump company where they were aggressively selling stocks selling stocks to their investors, but then they would dump their own shares of the stock and the price would tank. They were dealing with these penny stocks. Technically, they're being sold over the counter or OTC instead of on a stock exchange. So that's how the markets work. Any questions or comments? Let me do a time check here. Ooh, not good. We only have 6 minutes left. Okay.
5.5.
5.5, okay. In our globalization chapter, we talked about how the countries of the world are interdependent economically. Well, that's true in the stock markets as well. If a stock market in Asia is going down, it has impacts around the world and other stock markets. And investors often will invest in international investments because there's more potential upside. Countries that are not as developed as the United States, which is a lot of the countries in the world, are growing quickly. And so their companies have a lot of opportunity for growth. You can make a lot of money investing in those companies, but you can also lose a lot of money, right? Because there's more risk. Okay, the stock exchanges are regulated by the Securities and Exchange Commission, the SEC. The SEC requires that if you're going to be selling a stock or a bond, you need to provide a prospectus, any kind of security. You need to specify in detail what this investment is, so that the investor can study it and know what they're buying. Now, investors usually don't read the prospectus, but it is required that it be provided. If you're going to be investing, again, I recommend working with a financial advisor. If you're just getting started, my suggestion would be go to your bank or credit union if you have one, and they probably have a financial advisor that works there, and they're probably a pretty reliable person that can advise you. But if you are working with an independent financial advisor, it's really important to pay attention to how they make their money. Some are fee-based, and some earn a commission. The ones that earn a commission, they have an incentive to keep selling you things because they make money every time they sell you a new investment. The ones that are fee-based don't have that incentive. Their incentive is to make you as much money as possible because then they get a bigger share. So they get a certain percentage of your overall portfolio. So most investors today prefer the investment advisors that are fee-based. The ones that are commission-based are regulated by FINRA, and then FINRA reports to the SEC. So they're kind of indirectly under the regulation of the SEC. We already talked about insider trading. I'm not going to repeat that. I think we've mentioned the Sarbanes-Oxley Act.
Yeah, you mentioned that.
Good, okay. So that law requires the chief financial officer to sign off on the financial statements of the corporation. So that if there's fraud in the financial statements, the CFO can be personally held liable. That was a major change back in 2002. Some of the trends, the big investment companies now can buy and sell stock in seconds, maybe even milliseconds. Whereas if you want to buy or sell a stock, it takes a couple days. You call your broker or you do it on the app. It might show up right away, but it takes a couple days to actually clear, to settle. And so you might not actually get the price you thought you were going to get. So we as individual investors are at a disadvantage compared to these companies with high frequency trading. Regulation is increasing because frauders keep frauding. And so the regulators keep trying to find ways to stop fraud. And the investment companies, the ones that offer these funds, keep trying to find ways to bring costs down because a lot of investors are going to Robinhood or other online platforms to save money. And so the big banks, the investment banks, are trying to find ways to compete with that. Okay, so with the 2 minutes I have left,
A minute and a half.
minute and a half, let me just show you how the learning objectives connect here to these different graphics. The financial manager helps the company to achieve its overall strategy, which you see finance is a big part of the strategy. Let's see, some of the short-term expenditures companies have, things like inventory, rent, but they also have longer-term expenses, things like land, equipment, and buildings. If they need to borrow money, they could take out loans or what are called notes. They could also buy from their suppliers, but not pay them right away, right? That's kind of a way to borrow money from your suppliers. Companies use, especially corporations, use a combination of debt and equity to finance. Let's see, some of the different securities over here. There are, if you want to invest in the securities markets, you could buy stocks in small companies, medium companies, large companies, real estate companies. And you can buy all kinds of different bonds. So you have many different types of investments to choose from. Companies that go public, they list their stock on the stock exchange, as you see here with Uber on the New York Stock Exchange. And when you make a purchase, if you're buying a stock or a bond, you're not buying it directly from the other investor, you're buying it over some stock exchange through some broker or dealer. And the last graphic we have here, this just shows some of the different stock markets around the world. So the US is not the only game in town. There are stock markets on every continent except the South Pole. All right, any questions or comments?
No.
All right, have a good rest of the week, everybody. See you Tuesday.
I didn't know it was. Hopefully we'll. What? What clases before we went there? Because once she's around.